Hi, I'm Rob Van Raphorst. Welcome to MBANow. With us today is Lynn Fisher, our Vice President of Research and Economics, here to talk about our most recent mortgage finance forecast. Lynn, thanks for being here.
Thank you.
So can you tell us what we have in store for 2017? I know we just released our mortgage finance forecast and economic forecast, but it'd be good if you could sort of walk us through it.
Absolutely. Well, things are rapidly changing, so it's good to have updates. Our current forecast for mortgage origination volume is for it to be about $1.56 trillion in 2017. Now that's down from nearly $1.9 trillion in 2016. We expect that to flatten out a little bit in 2018 to come in at about $1.58 trillion. Now, interest rates, of course, have been changing. They rose rapidly after the election. Actually, they've gone up about 60 basis points over the last 3 months. But we expect the pace of that increase to start slowing a bit and to calm down over the course of the year, reaching about an average of 4.7% for a 30-year fixed-rate mortgage by the fourth quarter of this year, maybe exceeding 5% by the end of 2018.
Okay, so what are the factors that are sort of driving the decrease in originations in 2017, relative to 2016?
Right. Well, obviously, it's a story about interest rates and it's a story about refinancing that's tailing off as interest rates rise. Purchase originations are expected to increase, but not enough to kind of offset the decrease in refis. Now, on the purchase side of the market, we're expecting about a 10% increase in purchase originations. That's being driven by a very strong labor market. We've seen about 3% growth in real wages over the last year, so that's going to help offset the interest rate impacts a little bit on the purchase side. There's a few headwinds there, not a lot of inventory, et cetera, but hopefully more new homes will be built this year. So overall, maybe a 50% decrease in refinance activity. So on net, that gets us to a slightly negative place or change for origination volume in 2017.
But we're still, forecasting almost $500 billion in refinance activity, right? So I guess what does that look like, or who will be participating in that?
Well, basically a couple of things. A lot of people have refinanced over the last few years, have low interest rates, have those locked in, but there's still folks who are just now starting to see positive home equity and might be in a position to refinance. So there are still some folks, that might have the home equity now to do that, so they'll still be in the market. And you'll see a chart, I think, that we have on cash out refinancing. Those have been increasing over the last few years, again, kind of matching the increase in home equity that some folks have. The problem becomes that as rates continue to rise, those who've locked in those low rates aren't going to want to disturb them to do a cash out refinancing. So we might see an increase in, closed-end seconds, HELOCs, personal loans, other sorts of debts to help folks finance home improvements or other big ticket items.
Okay. Yeah, there's a lot going to be happening this year, and so we really appreciate you coming by and sort of walking through your thinking. And please come back again as things develop and let us know what to expect.
Will do.
Okay, thank you. Be sure to follow us on Twitter at MBA Mortgage, or check out Mortgage Bankers Association on Facebook and Instagram.